we're trying to help ease them, provide a bridge. Okay, we're talking your language. Bitcoin is not only a technology, it's not only one of the biggest ideas ever, the global monetary system, rules-based, digital, private, all of that. But it is a new asset class. And when you present investors with those three and they're not knowledgeable enough, it's a little bit threatening, or they feel a bit vulnerable. So we are trying to bridge in with, okay, we're going to talk your language. You need to look at this new asset class.
According to Cathie Wood, disruptive innovation is essential to preventing a worldwide financial collapse, not merely a fad. She contends that cutting-edge technologies like blockchain, robotics, Bitcoin, and artificial intelligence will transform sectors and spur exponential growth. According to Wood, those who ignore these advancements run the risk of falling behind, since old economic models are ill-suited to deal with the quick speed of the technological development. She believes that making investments in disruptive technologies is about future-proofing against the structural issues that the global economy is currently experiencing, not just about making money. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
And I think it is beginning to turn heads because, if you look at I think it's not even the 4-year moving average, which would capture the cycle, but the 3-year moving average. Bitcoin has gone up every year if you're using a 3-year moving average. And I think it's just becoming undeniable that it is a force that especially now that institutions have to consider it as a new asset class, because we've also put out there, I actually put it out in 2016, Bitcoin ringing the bell for a new asset class. We showed the correlations of returns. The correlation still, even though traditional investors are getting involved, the correlations with other assets still very low. It's absolutely essential that institutional asset allocators take a look at this asset. If they don't, they're not doing their fiduciary responsibility. So we're trying to help ease them, provide a bridge. Okay, we're talking your language. Bitcoin is not only a technology, it's not only one of the biggest ideas ever, the global monetary system, rules-based, digital, private, all of that. But it is a new asset class. And when you present investors with those three and they're not knowledgeable enough, it's a little bit threatening, or they feel a bit vulnerable. So we are trying to bridge in with, okay, we're going to talk your language. You need to look at this new asset class. There are 50 bills going through 22 states right now around Bitcoin reserves. So that's very interesting. Texas, Arizona, and Utah, I think, have seen progress within the last week, which is very exciting because Texas and California, each of those states is bigger than Canada. And of course, Canada is huge in terms of a gold resource base. Big ideas, 2025. And we've become fascinated with the convergences among all of the technologies around which we have centered our research. So we've centered our research around the 5 major innovation platforms evolving today. So as you said, Anthony, robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the life science space. AI, if you look at the convergence chart in that deck, and compare it to the one we put in last year, what you see are the convergences are intensifying with AI, really the heartbeat of convergence, pushing everything along and accelerating the pace of change, and also accelerating the deflationary undercurrents. And I know this is very controversial, but accelerating the deflationary undercurrents that we believe are going to intensify. Deflation, not bad deflation, good deflation. When you cut prices, you enable more access, right? So if you look at the convergence chart, we've focused, of course, on blockchain technologies and agentic AI. I think if he only has 2 years before he effectively becomes a lame duck, and he knows that, which is another reason I'm posting this, because let's get this thing going as quickly as possible. If we said, we're taking your tax rates down, choose a percentage, 3 percentage points, retroactive, if they did this very soon, to, February 1st, or March 1st, let's say, and they finish the negotiation, that would take the uncertainty away. That would take that very important uncertainty away. And honestly, I think we will have a booming economy with much lower than expected inflation, because the productivity gains, after we've been through this rolling recession, and now here's the last leg of it. We were housing, autos, capital spending, small businesses creamed, lower income creamed, finally high income cracking. We're ready for a massive productivity increase, which, I learned again in the early 80s so much. Productivity increases and a rising dollar are two of the biggest antidotes to inflation. And I think we're going to be shocked at how low inflation goes.
Cathie Wood points out that 2 key factors causing deflation in the past were rising productivity and a strong dollar. She contends that the economy has been severely strained by the Federal Reserve's aggressive rate hikes, which have increased rates 24 times since 2022. Wood, however, thinks that inflation will not just slow down but may perhaps drop precipitously as various industries become more efficient and productivity rises. She also notes a change in consumer behavior, with both individuals and companies postponing purchases in anticipation of future price reductions and reduced loan rates. Her thesis that we might be approaching a time of disinflation, or possibly deflation, in the near future is supported by this cautious spending and a weakening economy. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
Yeah, I've started, I sometimes get to thinking about something, and if I'm not hearing about it in the press, and I'll just start posting on X. And so, yes, this has been my latest. So the velocity of money is the rate at which money turns over. Now, in an environment of fear, which is what we have right now, in an environment of fear, what do people do? Well, you've got, I'm going to say 30% of the labor force, which is in either government or quasi-government, including healthcare, education, and so forth. 30% or more of the labor force is saying, am I going to have a job? How is this going to filter down to the state and local sector? That's where the bulk of the jobs are. So there's fear. And that will slow the velocity of money down. So it hit me when Walmart came out and said, 2025 is going to be a big slowdown. Last year they had 5% same-store sales. Now they're saying it's going to be 3 to 4%. So that's a 30% deceleration in the growth rate. So that's a change in a change. So that's, for them to be so sure now, they're seeing something they do not like. So part of it is fear, but there's another reason people will delay purchases or business activity. If they think their tax rates are going down, and again, lesson from the early Reagan years, if they think their tax rates are going down, they're going to wait and hold off on a lot of activity until they understand what that means. And if you listen to Kevin Hassert recently, he's been talking about the quid pro quo between tariffs and taxes. What that means to me, given that Art has been an advisor to every president with the exception of 2 in the last, I'm going to say 30, 40, 50 years, is that we're moving towards a flatter tax system and lower rates for everyone. That's Reagan Revolution. Reagan delayed the impact, the full 25 percentage point reduction, took 3 years. The economy fell into 2 recessions. Why? Well, there were a lot of other reasons, but we learned very quickly in 1983, oh my gosh, we went into a boom. They were all waiting for that last time. So you've got fear of unemployment. You've got, wait, how much of a better deal am I going to get out there? And the same thing with pricing. If people think prices are coming down and interest rates are coming down, as President Trump is telling us, and long rates have started coming down. Nobody believed that was going to happen. They're going to hold off for the lower rates and lower prices. So those are 3 delays. Now, what does this mean? Today, we got Atlanta's GDP now estimate is negative for the first quarter. Negative GDP. Now, we have been saying, and many people didn't agree with this point of view, but I think it's playing out now. We've been in a rolling recession since the Fed started raising rates in 22. It jacked them up at a record-breaking pace. We've never had anything like that. You go back to Volcker, everybody remembers 20% interest rates. Yeah, went from 10 to 20%. That's a 2-fold increase. We went up 24-fold in little more than a year's time. That was a major shock to the system. And I think we have been one sector after another moving to the one that did not capitulate was the consumer. And it did not capitulate because of the high-end consumer. Well, guess what? In the last University of Michigan consumer sentiment survey, the high-income earners' confidence cracked. So I think we're going to see a completely different tune in the next few months.
According to Cathie Wood, in periods of fear and uncertainty, the velocity of money, the pace at which money moves through the economy, slows down. She points out that when economic uncertainty permeates municipal and state levels, about 30% of the workforce is concerned about job security, particularly those in government-related occupations like healthcare and education. The economy is further slowed by this pervasive dread, which lowers corporate activity and spending. Wood cites Walmart's most current 2025 prediction, which shows a sharp deceleration in growth, with same-store sales growth falling from 5% to between 3 and 4%. A significant change in consumer behavior is shown by this 30% slowdown. When big businesses like Walmart voice these kinds of worries, Wood says they are probably observing concerning trends in consumer demand and the overall state of the economy. Wood notes that anticipation of lower taxes are another factor contributing to the postponement of spending, in addition to anxiety. She cites experiences learned during the Reagan administration to illustrate that when individuals look forward to future tax cuts, they frequently put off making significant purchases until they can take advantage of the reduced rates. According to her, the current political atmosphere, which includes debates over taxation and tariffs, may portend a shift toward a flatter tax structure, which would further encourage individuals to put off spending. The expectation that prices and interest rates will decline is another important factor affecting consumer behavior. According to former President Trump, long-term rates are already dropping, so many businesses and customers might put off purchases in the hopes of finding cheaper prices. 3 main factors contribute to delayed economic activity. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.